have your typical investment management fee, which a lot of providers will have market link included in terms of what they charge for managing the underlying assets. So that is what is being charged to the investor, to the member. But there's a separate dimension that gets brought in on a smooth bonus product in the form of the capital charge. Now, a product needs to, of course, be viable from a company's perspective across both charges. So it is very possible to make one charge look better than the other when looking at the charges being charged to members. So you could potentially, hypothetically, inflate the investment management fee while reducing the capital charge just to make things look better. But at the end of the day, what is being charged to the client is both those fees. The key thing to remember when comparing smooth bonus portfolios specifically is to look at both charges together, because you can find ways to almost seem quite competitive from one charge's perspective when not considering the other. So we of course try and avoid that in totality. We are very explicit with the fees that we charge. Even though you should look at them together, we do make it appropriate for each of the fees being charged. So from the investment management fee perspective all the way to the capital charge perspective. Now, looking at the industry as a whole, you'll generally see similarities in the fees being charged. And we have, of course, really tried to position ourselves as best as possible when it comes to competitiveness of fees. So on a capital charge basis, we are really, really competitive, especially when you're looking at the likes of AGP Smooth, where it comes in at 20 basis points. Similarly for AGP Stable at about 70 basis points, you are looking at very, very competitive propositions where the guarantee levels are 50% and 80% of fund value. So that then speaks to a slightly higher charge, but commensurately a slightly higher guarantee associated to that. So that is why the likes of AGP Stable with the 80% of fund value guarantee has a 70 basis point capital charge. And similarly, AGP 50 with a 50% of fund value guarantee has a 20 basis point capital charge. What's important to note is that for the likes of AGP Smooth, you are essentially buying into a proposition which is focusing mostly on smoothing. Now, I'm going to pause here a bit and speak a bit about the capital charge itself, just to get some idea as to what it really represents. So for a smooth bonus portfolio, you are taking an extra step when you are declaring returns back to members. So we declare that back to members in the form of bonuses. So we'll take our underlying return from our underlying portfolios, but we almost transform that into a less volatile return through our smoothing methodology, and that ultimately gets passed on to members through these smoothed bonuses. That does require infrastructure, it requires a policy administration system, it requires a team, it requires market value adjustment application to ensure equitability between different members. And that ultimately means that you should be charging separately for a smooth bonus portfolio because there are additional costs to provide the smoothing infrastructure. So why that is important to note is when considering the fee construct of smooth bonus providers, it's always important to note that there will be a fee somewhere for smoothing provided, because smoothing is not in and of itself, it's not free. It is something you have to do extra effort to achieve. There's a lot of extra things you need to consider in addition to what a typical balanced fund would consider. So bottom line is, whenever comparing fees, remember to take investment management fee and capital charge into account. And for maybe providers that don't necessarily provide that breakdown, it's important to consider that probably implicitly within that somewhere, there is a charge for the smoothing methodology used, and if there's guarantees, for the guarantees used in that product.